Welcome back, WSU Vancouver VITA volunteers. This is our first slideshow covering material for the VITA Advanced Tax Law exam. You'll notice the little ribbon in the upper right-hand corner there of the screen that shows that this is an advanced tax topic. It's important to note this little ribbon because this lesson and all of the advanced lessons will assume that you have been through the basic certification lessons. So we have this ribbon, and all of the advanced tax law lessons will have this ribbon to let you know where you are in the training. So if you're thinking, wait a minute, I didn't watch the videos for the basic training, you will want to do that before watching this video. If you did go through the basic training, but you don't feel like an expert yet, or you feel like you might have forgotten some stuff, that's okay. You can always review, and we will be practicing some more on basic stuff naturally as we go through the advanced material. But if you haven't seen the material for the basic at all, you will really want to watch that before watching this. So in this lesson, we will be delving a little deeper into the retirement income lesson of publication 4491. And again, if you're feeling like you don't remember everything about what we covered in the retirement income lesson, you can always go back and review the basic video. In this lesson, we'll be covering a little bit more about how to figure out the taxable amount, using the simplified method, and a couple of other related topics. So if you remember back to our basic lesson on retirement income, our taxpayers are going to come to us with a Form 1099-R for retirement, or an RRB 1099-R, which is a railroad benefit retirement. A lot of times, the taxpayers will bring the form and the taxable amount will already be determined on the form, and we can just enter things as they are on the form. But sometimes the taxable amount has not been determined, and so that leaves us to figure out what amount of this distribution is going to be taxable. So if you remember back, we discussed how these special plans, qualified plans that our taxpayers have been putting money into, sometimes they have been putting money in that has not been taxed already, but sometimes they have put money in that has already been taxed. So if we don't figure out what the cost was in this plan, they're going to get taxed twice. And so we want to always avoid double taxation. So that's why we are doing this process. And then there's a special method that we are going to use as VITA volunteers called the Simplified Method to help us figure out how much of these distributions are taxable. So just a recap on what our Form 1099-R is going to look like when the taxable amount isn't determined. We'll have box 1 will be our gross distribution. Box 2A might be a 0 or it might be blank, and there is an amount shown in box 9B. So box 2A is the taxable amount. Box 9B is the total employee contributions to this plan. So that's the cost of the plan. Another way that we might find that the taxable amount needs to be determined is that box 1 and 2A have the same amount, and the taxable amount not determined box is marked in box 2B there. There's a little check box. So that will be checked. And we really didn't look at this form, the Form RRB 1099-R, for our Tier 2 railroad benefits in our basic lesson because the taxable amount has never been predetermined for this form. And as we discussed before, this is an advanced topic, so it requires advanced certification to determine the taxable amount. So looking at this form, you can see that we have some boxes and they kind of relate back to some of our 1099-R boxes. So you can see there in box 3, we have our employee contributions. That's just like the 1099-R box 9B. And then in box 7, we have the total gross paid. That's like our 1099-R box 1 gross distribution. And then federal income tax withheld, you'll see that that is box 9. That is the same as 1099-R box 4. And then there's a little box there down at the bottom, box 12 was the Medicare premium paid. And that would be something that flows to Schedule A if we have a taxpayer who is itemizing their deductions. Itemizing deductions is an advanced topic that we'll talk about in a few lessons, so don't worry if you're not knowing what's going to happen there. So in order to calculate the taxable amount using the simplified method, we're going to need some information from our taxpayers. We need to know their cost in the plan. We need to know the taxpayer's age, and that's on the date the annuity began, not their age at the end of this year. So that can kind of trip you up. So it's important to remember that that's the date when they started receiving these payments, what their age was on that date. And then we need to know the total of the tax-free amounts that they already collected in previous years. So the total employee contribution on Form 1099-R is our cost in the plan. And if we're looking at a RRB 1099-R, that's going to be that box 3. So as we just talked about, we need to figure out the taxpayer's age, and that's the age on the date the annuity began, so whenever they started receiving these payments. So it's really important that we're talking with our taxpayers to figure out all this information. We can't just necessarily put this together ourselves. We need some input. So it's important to note too, because we need to find out whether the annuity starting date was before or after the taxpayer's birthday for that year. So they might have started receiving payments in the middle of the year, and it's going to make a difference whether that taxpayer already had their birthday or didn't have their birthday yet when we want to use their age in this calculation. And then there are joint and survivor annuities. Those are types of plans where the spouse, if the owner of the plan passes away, the spouse continues to receive payments. If we are looking at that sort of a plan, then we need to be adding the spouse's ages together. And again, that's based on the starting date of the annuity when they started receiving payments, not necessarily their ages for the current tax year. And then we need to know the previously recovered tax-free amounts. So what we're going to be doing with this simplified method calculation is figuring out, a portion of the distribution that is taxable and a portion that is tax-free. It's already been taxed. So we need to know how much they've already recovered of those tax-free amounts. And this is available from the taxpayer's prior year worksheet. So this is why we love when our taxpayers bring in their previous year return, and we can start to figure out, what they've already taken on this. Sometimes they don't come prepared with their previous year returns and they don't know how much they've recovered. If that's the case, then we can enter the monthly tax-free amount from our calculation and multiply that by the number of months that they had already been receiving payments prior to 2021. And so regardless of whether they actually claimed on those previous returns that we know nothing about, that doesn't matter. What matters is that we are showing the same amount, the tax-free amount, based on the calculation times the number of months that they had been receiving these payments. So now I know you're wondering, how on earth do I figure out the monthly tax-free amount? So that's just the taxpayer's cost basis. So, that's the employee's contribution into the plan. divided by the number of monthly payments, and that comes from a table, which we'll look at shortly, and that equals the monthly tax-free portion. So it's important to remember that's the tax-free portion. The taxable portion would be the total distribution minus the tax-free portion would equal the taxable portion. And the IRS kindly made us a worksheet to help us figure out the simplified method. It's called the Simplified Method Worksheet, and you can find that in Publication 575. TaxSlayer, if we're entering the right things into TaxSlayer, it will automatically generate this worksheet for us, so we don't have to necessarily look it up. If you're in a situation where you need to find out what that tax-free portion is to figure out retroactively what amounts are previously recovered tax-free payments, then you would want to maybe go to Publication 575. And the reason why, in that case, you would want to be looking for the Simplified Method worksheet in Publication 575 is because at the bottom of the worksheet is a table that helps you figure out, based on the age of the taxpayer at the annuity starting date, how many months to figure for the monthly tax-free amount. So remember, our calculation was the total employee contributions, that box 9B of the 1099-R, divided by the number of months, which you just found from using this table, and that will tell you what the monthly tax-free amount is. So you can multiply that by the number of months that they've been receiving this annuity before, or these payments before 2021. And as I said before, the Simplified Method worksheet is in TaxSlayer. So a lot of the calculations figuring out the Simplified Method and the taxable amount of this 1099-R is done in the software for you. It's just that monthly tax-free amount that it's a little easier to just look it up on that table on the printed worksheet from Publication 575. But other than that, you're pretty much just going to be using TaxSlayer to figure out the taxable amount. So what you end up doing is you're entering the box 1, the gross distribution from the 1099-R, just as it is on the form. And then when you tab out of that box, box 2A, the taxable amount, will automatically populate as being the same as box 1. So if the taxable amount is not determined on the 1099-R that you have in front of you, don't adjust that amount, don't enter 0, just go down a little ways and there's this link. Do you need to calculate your taxable amount? Click here for options. And so that's what you will click on to pull up the worksheet. Once we've clicked on the link for the Simplified Method worksheet, we'll have another page with a menu come up with just a couple of options. We'll calculate the taxable amount using the Simplified Method worksheet. There's also this Public Safety Officers Distribution. We'll talk a little bit more about what that is in a few slides. But if we're using the Simplified Method, we're wanting to click on that Simplified Method worksheet to begin that. And then we'll get a notification that pops up, the Simplified Method qualification. And so there are some criteria that our taxpayers have to meet. They most likely will meet these in order to use the Simplified Method. They have to use the Simplified Method if the starting date of the payments were after July 1st of 1986 and they used the Simplified Method last year. if they started receiving payments after November 18th of 1996 and they were under the age of 75 and entitled to less than 5 years of guaranteed payments, then they must use the simplified method. They can use the simplified method if the payments were from a qualified employee plan, a qualified employee annuity, a tax-sheltered annuity plan, such as a 403B plan. So these are all tax-sheltered kinds of accounts that people had been putting money into. And then if they were under age 75 at the annuity starting date, or they were entitled to less than 5 years of guaranteed payments, then they are also eligible to use the simplified method worksheet. They cannot use the simplified method if this is from a non-qualified plan, or they don't meet the requirements that we just kind of went through. Then they have to use what's called the general rule. And if they need to use the general rule, then that return is going to be out of scope for us. So, but we don't run into that very often. Most people are going to qualify to use the simplified method. Once we've determined that our taxpayers qualify to use the simplified method, we hit continue, and TaxSlayer will bring up for us the simplified method worksheet screen. So you can see that it will pull over automatically the gross distribution amount. The plan cost at the annuity starting date is where you put that box 9B from the 1099-R, or from the RRB 1099-R, it was box 3. You put in the starting date of the annuity. So again, we're talking to our taxpayers, oh, when did your retirement benefits start? To find out that date. And then there's a little checkbox to if this is a joint or survivor annuity. So, you know, again, interviewing with our taxpayers, does your spouse still receive payments on this benefit after you pass away? And then you can figure out the age of the recipient at the starting date. And remember, if you check that box for joint or survivor annuity, you need to add the ages together. And remember that this is their age at the start of the annuity, not this year, unless they started the annuity this year. And then a little further down, it wants to know how many months were paid in 2021. So unless this just started in 2021, it's most likely going to be 12 months that they were receiving these payments. And a little further down the line, which you can't see on the screen now, it asks you what were the tax-free amounts that were already taken. And as we talked about, sometimes if we don't have a previous year return, the easiest way to figure that out is from the paper simplified method worksheet. Just do a quick calculation on that. So now that we've discussed how to use the simplified method to calculate the taxable amount of distribution from a qualified plan where that distribution, that taxable amount wasn't previously determined for us, we have just a couple of small topics to talk about in regard to retirement income. And the first of these is required minimum distributions. And these distributions are required to avoid an excess accumulation in these tax-favored accounts. The plan administrator should notify our taxpayers when they reach the age that they need to start taking money out of the account. They have what's called an RMD requirement. The age that would happen for taxpayers who reach their 70th birthday before July 1st of 2019, they had to start taking their RMDs out by the age of 70 and a half. So they should have already started. If their birth date was after July 1st of 2019, then they would start taking their RMDs out by age 72. They do have in the first year through April of the next year to go ahead and make this, this distribution. After that, then they're expected to have taken the distribution by December of the tax year. And the penalty on this is quite high. It's 50% of the difference between the minimum distribution and the amount that they actually received as a distribution for the tax year. So if we see taxpayers who are going to get this penalty, we need to refer them to a paid preparer. They might be able to request a waiver of this penalty, this extra tax, on Form 5329, but that is out of scope for our program. Qualified charitable distributions are non-taxable distributions that are made directly by the trustee or whoever is holding this account of the IRA to an organization that's eligible to receive tax-deductible contributions, so like your 501c3 charitable institutions, those kinds of places. The taxpayer needs to be at least 70 and a half to make this kind of a distribution. And the important thing is that this counts towards the required minimum distributions. And this qualified charitable distribution can also be excluded from our taxpayers' income. So there are instructions how to do this in publication 4012. So if you run across somebody who has made one of these qualified charitable distributions, you'll want to look up in publication 4012 how to do that. And then the excludable amount is reduced by any IRA deductions that the taxpayer may be taking. So there used to be a limit on how old you could be to continue to put money into a retirement account, and that's no longer. So sometimes you might see people who are still putting money away into an IRA, but they're also making distributions out of the IRA. They might be making these qualified charitable distributions and putting money away into their IRA. So you would have to reduce the charitable distribution amount by any deduction that they took for the contributions into the account. And then, as I talked about a little bit before on that simplified method menu screen, there was public safety officers exclusion. So this is where we're talking about that. Basically, a law enforcement officer, a firefighter, a chaplain, a member of a rescue squad, or an ambulance crew, they can elect to exclude from their income up to $3,000 of distributions as long as they were made directly from a government retirement plan to a provider of accident, health, or long-term disability insurance. So now that we've talked about how to figure out the taxable portion of a retirement distribution or an annuity plan distribution using the simplified method, and we talked a little bit about required minimum distributions and qualified charitable distributions and the public safety officer exclusion, here's what I want you to do. Go ahead on over to Link and Learn, and beyond just doing the skill check questions, why don't you challenge yourself a little bit and do as many of the skills workout questions as possible. If you are not just a volunteer, but you are also in the Accounting 496 class, instead of doing the skills workout, you will have a quiz in Canvas that you will be doing with similar kinds of questions. And then in TaxSlayer, there's going to be a practice return, so go ahead and give it a try in TaxSlayer. For the Accounting 496 students, we will be doing that TaxSlayer practice in class together. And then, as always, we have our publication 4012. These are a little more complicated tax topics, and so certainly when you have a taxpayer come in with this situation, do not feel bad looking this up. In fact, you will need to. I need to look it up when I have a taxpayer come in with this kind of a situation. And then we have publication 4491, which gives a little more detail than this video, and is always a resource. Remember, the resources are available to you when you take the advanced certification exam. It's open book, so feel free to use the resources.